Hey guys, Ken from Investing Made Easy here. Before we start, make sure to like, comment and subscribe for future videos like this. Today we are going to be starting a new series that I'll be calling Investing Strategy Saturday. In this series we'll be discussing a different strategy every week to give you a diverse arsenal when investing. This new series will begin to help you to make informed decisions in the stock market, eventually allowing you to progress to develop your own strategies and risk tolerances for investing. But why choose a strategy? Surely I can make my own decisions and be successful. This is what I thought when I began. However, more often than not, you overpay for a share that doesn't have much room for growth. Having a set strategy that you use will give you more success in the long term. Keeping emotion out of investing will give you the best success as well. Most strategies generally rely on a constant income stream to fund them. This could mean setting aside a part of your income to invest in shares. The other option is to create passive income for yourself, which you can then use to invest into stocks. Check out my other videos on these two topics of saving money and creating passive income to help you create the money that you can use to start investing in companies. The strategy that we are going to be looking at today is fundamental analysis. But before we begin, I have some warnings and some advice when trading. First of all, this is not professional financial advice, but tips and tricks you can use to improve your success on the markets. Firstly, there is no silver bullet for investing. I can never guarantee you that investing will always make you money, because it might not, but using a set strategy can help you improve your chances in trading. No single ratio is the golden ratio. Each one indicates a certain quirk of a business, and it is the job of the investor to work out whether the odds are aligned in their favour. However, the more time you spend observing the markets, the better you'll become at spotting trends. With some sites such as Trading 212, they offer £10,000 trading accounts which you can use to practice with before using your real money. So what is fundamental analysis? Fundamental analysis is looking at a business at its most fundamental level, looking exclusively at ratios and determining the value of a stock, whether it's undervalued, is it going to go up in price, and is it going to give me a good dividend yield. There are some investors who use this strategy exclusively. However, it's good to mix in different strategies as it lets you have a wider field of vision when investing. Okay, let's have a little look at earnings. Earnings are the bedrock of this strategy. But first, what are earnings? Earnings are essentially the profits of a company. This allows us to gauge how much money a company is making at the moment and how much it may make in the future. If the earnings are high, this means the company is making more money. A successful company needs to be making money. High earnings leads to an increase in stock price and an increase in dividend yield. However, on the other side, if a company misses their projected earnings, this leads to a decrease in confidence in the company, which can decrease the stock price. Let's look at some important ratios. Firstly, the EPS or earnings per share. This is the proportion of profits allocated to each stock. This is useful for us as it is an indicator of how profitable a company is. There is no one figure for this ratio to look out for, as different companies are different sizes. However, looking for an annual growth of EPS of around 7% or higher is ideal, as this shows the growth of a company rather than a stagnation. Next, the PE ratio or price to earnings ratio. This is the share price relative to the per share earnings. This is an indicator of value of a company. A lower value is generally better as you're paying less per share for the same amount of earnings compared to a company with a higher P to E ratio. We should be looking for a value of around 25 or less. Now, the projected earnings growth, or PEG, is the prediction of the growth rate for the next year. Ideally, we are looking for a value greater than or equal to 7%, which indicates growth for the future. Sometimes it's not always best to follow the projected earnings that a company states, but try to create your own rough estimate by looking at market trends and other ratios, as well as real-life events. But obviously that could also be risky if you're inexperienced. The PB ratio or price to book ratio, which can also sometimes be known as the price to equity ratio, this is an indicator of undervaluation. We are looking for a value of less than or equal to 3. Buying a company that's undervalued gives you the best odds for a higher return, as you're able to buy a larger stake in a company and therefore experience greater yields. And finally, the dividend yield. This is the yearly dividend compared to the share price. This is what percentage annually you will get back on the shares you own. This is a great way of building passive income. This can also be an indicator of an undervalued company. If the company's dividend yield is higher than its 5-year average, it could mean that the company is undervalued. This is for two reasons. The company may feel that its share price is undervalued and therefore is attempting to attract investors with a high dividend yield, or that the company is doing really well and believes sharing its profits with the investors does not have an adverse impact on the company. Now, let's look at some websites we can use to help us with fundamental analysis. We know that although earnings are important, they don't tell us very much on their own. We therefore need to use some other ratios, which I've listed above, to give us a better picture of what is going on. You could work out all the ratios yourself, however there are now many sites which can give you the information automatically. Links to the websites used will be in the description. For current statistics, Yahoo Finance is great. It presents all the information in easy to follow tables, as well as plots some nice graphs. However, for trend spotting in the long term, it can be hard to find the information. Morningstar is a great website for this. They have all the previous data for the past 10 years and just about every ratio you could ever need, plus more. If you want to create your own concise tables, Excel is great. You can download all the data online straight into an Excel spreadsheet. From here, you can plot your own graphs and look at trends. Thank you very much for watching this video. If you like this video, make sure to like, comment and subscribe for more investing strategy videos every week. Also check out my other videos for great advice on how to improve your investing skills and financial development. This is Ken from Investing Made Easy. I'll see you later.